Welcome back, ladies and gentlemen, to a very prevalent discussion that I started off yesterday, taking a look at the fintech sector getting pretty much clobbered. I mean, we were looking at Zoom trading down. What is it at right now? I mean, it's down a whopping like 40. Oh, no, it's way more than that. From the all time highs, we're down a whopping 63% here, folks. I'm hoping we are getting nice and crisp, clear audio this second time around. Let me know in the comment section if there's any issues. Sorry, when I have my headphones plugged in, we lose a little bit of audio. But today I want to summarize the reality of what people are starting to see, I think, which is bubbles in different sectors of the market. And I want to talk about how we invest, how we're going to trade on these, because I am by no means not some kind of bubble investor. I mean, I've recognized things in the MJ market early on that turned into massive hype stocks that eventually had crazy corrections. But first and foremost, I just want to kind of give you guys the exact definition of what a bubble is coming from Wikipedia, because I think this is talked about a lot, but people kind of disassociate from it these days, right? Because a bubble is an economic cycle that is characterized by the rapid escalation of market value, particularly in the price of assets. This fast inflation is followed by a quick decrease in value or a contraction that is sometimes referred to as a crash or a bubble burst. And again, this is kind of secular, but it was wild watching the volatility in the market yesterday. And I also want to point out the fact that into the end of a year, usually the VIX, the volatility index, which if you don't know what that is, basically it's been kind of an indicator to stock market corrections or basically volatility in the market, which it just kind of represents the volume of stocks being traded in any given day. In the last 5 days, it has been up a lot higher than it has been for the last month. But we are also heading into the end of the year. And this is where we're seeing companies, hedge funds, whatever, booking profits, booking losses to do write downs, and then they're reallocating that capital, usually to what they're going to define as the path of least resistance to getting some more gains into the end of the year. And it looked like that happened yesterday. We saw so much selling off going on and this positioning going on with things like Apple and Microsoft. Like, how did Apple and Microsoft end so well the other day when the rest of the market is just getting slaughtered? And I'm finding it really intriguing because Warren Buffett had some very incredible quotes. I think it was Warren Buffett. If it's not, you can requote me. But he always said, when you talk to your taxi driver or the neighbor's kid, and they're talking about things they don't know anything about, making 1,000% gains, it's usually an indicator that there could. I don't know if that was a coined Buffett quote, but still, we're going to go through some of these sectors real quick, guys, and I'm just going to talk about some of these stocks, some of the investments I have that I would highly consider to be in an overinflated bubble at this point. And we're seeing a lot of economists. They've been saying this a lot, though. I mean, these economists, and they're always going on, right? Your Peter Schiffs, your rich dad, poor dads out there, Robert Kiyosaki's, and it's just crazy. Let's dive into some of these real quick, guys. I want to first and foremost, obviously, maybe talk about the EV sector first, the crypto market here. And I kind of want to bleed in through some of the corrections that we've already seen from past hype, because I feel like all these different sectors can really teach us something. And it really kind of resembles these stock charts. I mean, when you look at Zoom right now, for example, I mean, that stock chart is very reminiscent of a lot of companies that haven't reached the other half of that yet. So anyways, let's dive down into the crypto market first and foremost, because this is where I feel like the massive bubbles are starting to be created. And it is quite apparent because in the crypto world right now, if you were talking about a 10% gain, you are a joke, good sir. No one cares about 10% gains in this market. It's laughable at this point, right? In the crypto market, 500,000% gains are the new norm. And this is like the early days of the internet, and it's like the early days of the dot-com bubble. It's like the early days of social media. 98% of these companies, these cryptos, they're going to be gone. People know that. Go watch people like Alex Becker. There's some real guys I have a high amount of respect for trading the cryptocurrency market right now. And it's pretty entertaining. I must say, man, like, I haven't dabbled down yet because my brain has a hard time working in the gambling realm when I know I'm spearheading away from like valuations and cash flow. But in the crypto market, man, I'm looking at altcoins. I'm watching tons of YouTubers. I'm getting very intrigued by it from a trading aspect because it's so reminiscent of any bubble I've ever seen in any market. People don't care about valuations. I've never heard anybody in the real world say, "Hey, I'm using this example altcoin to run this on my program." That shit doesn't exist. There's projects. I mean, Ethereum is a project. It's a pronounced project, but that's all it is still, right? I mean, it's not some kind of cash flowing, generating. There's no fundamentals. It is purely supply and demand. And when there's only supply and demand, kind of reminding me of the Wall Street bettors of the world, 1,000% gains come around. And you don't have to be a genius to make them, but you can't enter that market with an actual investing mindset. It's damn near impossible. And yeah, I mean, I found a few that are interesting. People making big calls on things that should double and triple, and I don't see why they wouldn't. I've been working with a lot of crypto companies right now that are exploding or funware. Funware stock has been another great example of a stock specifically that has been dabbling very successfully in the crypto market. I think they just bought over 500 bitcoins or something like that. But the reason I just want to talk about this openly, because I'm not for or against this. I just think it's something that you just need to look at, understand it for what it is, and then make the intelligent decision based off that. And if that's something that interests you, I mean, allocate a percentage of your portfolio, but you also have to recognize that if you allocate too much, you're only going to be making 1,000% gains for so long. And then things are going to just go completely in the other direction, and it's going to happen inevitably. It's going to. I'm telling you that. I don't have a magical wand to tell you exactly what date, but you can quote me on this now that the crypto market's probably going to go through a worse bear market than the initial crypto crashes we saw before, because the sector's too large now, and Bitcoin and Ethereum still make up quite a tiny percentage compared to the entire market that we're seeing come into fruition, and they can't be worth 30, 50, $100 billion valuations. They just can't. But you're watching these small cap billion-dollar cryptos immediately run into these 10, $30 billion valuations, right? So let's shift from the crypto market real quick, because I think it's more prevalent right now that people see this within, say, the EV market. And I completely understand, and I completely agree that I think Tesla in this current moment is in some kind of crazy bubble where no matter how you run the math, it doesn't lead anywhere until you're a decade out. And that is obviously a big problem. And now we're starting to see that frothiness really bleed into anything investors get caught in the story of and care more about the momentum than the actual business fundamentals, right? Rivian, Lucid, just any EV company. I mean, it's kind of almost hilarious that these foundational, and I'm not a big fan of them. I know I bash GM, I bash Ford. I can respect their businesses. They're fairly valued companies, and they're making a transition with everyone else. But it's crazy to watch the GM CEO claw at the idea of how is Rivian worth 100 billion, and what are they trading at right now? I know they've been on the up. They should be on the up. I don't know how these companies that have a bigger foothold in the EV market than companies that haven't even delivered yet. I mean, where are they, General Motors? What are we sitting at here? Like a $91 billion valuation, which looks like it's rebounded a lot from those bottoms. I mean, it's trading up 28% on the year. It's up 55%. So it's kind of getting some of that momentum, right? What's Rivian at here right now? Are they catching up to Rivian? It's kind of so weird when you kind of compare the fundamentals, because there's an obvious disconnect in a level that's not even it's laughable, right? So PE ratio on GM right now is 8. I don't think you're going to find 8 PEs very broadly across any market right now. If my internet would gladly load, I want to take a look at Rivian stock real quick just to see where we're at. But you guys got to understand right now that this hype is going to burn out. I mean, Elon Musk is the caveat that keeps Tesla going. And I mean, if we get to Mars, if the factories keep smoothing out and he doesn't tweet too much more than other than he's tweeting on the throne, the porcelain throne, as he quoted a couple days ago there, I mean, it's going to be okay. But yeah, Rivian's worth 102 billion. They're worth more than GM, right? So when I own Tesla stock, guys, and I've traded it, I've made profit on it, I'm still considering selling more of it. I'm just trying to play this kind of either average waiting game to see if it goes higher. If it drops, so be it. It's not that big of an exposure to a degree at this point. But I also recognize the fact that, like, if you're holding Tesla, it's a 15-year play at this point. Like, it doesn't matter what comes online. It doesn't matter how good self-driving is. There's nothing that can back the momentum or the hype. And that is a little bit edgy, right? But again, if you're coming into these companies and you're getting these huge run-ups, I think what you're going to be wanting to do is obviously take profit. Bring the machine. Doesn't matter if it keeps going higher. We don't know how long this lasts. We don't know when it comes to an end. But the idea behind doing this is reallocating that money to something that matters. And I know this is something we don't talk about a lot here anymore, but dividends, cash flow. I mean, that's the end all be all is free cash flow. I can't remember the last time I heard somebody really bring up free cash flow on any company they talk about anymore, because I mean, I work with a lot of companies that don't have any cash flow at all, but that seems to be the market these days, right? But so we'll talk more about positioning capital with profits in a second, but I want to kind of shift back to the focus of some more of these markets that have kind of seen these secular run-ups and now are kind of pulling back. And the SPAC market is another great example of this right now. Do we remember how on fire the SPAC market was, running up 500,000% gains? And now most of the SPAC market has crashed. Whether they've come public or they're still waiting to come public, they're getting decimated. It's just that market has fizzled out. Unfortunately, the SEC stepped in. They made some new rules. They made it harder. It was too much of a hype market. And that's the problem with crypto. That's a big problem with crypto. And it's so funny that people don't recognize that risk. It is a completely unregulated market, and everybody has the legal right to pump and dump it. Whales are primarily controlling the market. That's the only thing that has really shifted in that aspect of that industry. And it makes it that much more of a bubble because it can be manipulated. And it is being manipulated. It doesn't take a genius to go look at the wallets and the number of Bitcoin or these altcoins that are trading and see that it is huge money, big billions of dollar accounts moving those altcoins. And it doesn't take a genius to say, why would someone do this with all that money? Because you're going to talk about it. You're going to get hyped. You're going to buy it and they're going to offload it. I mean, it's just so apparent that it's like laughable at this point, right? So crypto's a joke. Doesn't mean it's not investable. It's just you got to be careful, right? And same with the EV market. There's nothing saying that it's a joke. It is a real foundational business, but we're too early days still for the valuations we're seeing. So and this bleeds into the rest of the market, which kind of gets me a little bit terrified, right? Because right now you can either make insane overpriced investments or you can make relatively valued investments. And to get cheap stocks, you're taking on way too much risk because you're not going to get any capital growth. Let's be real. GM's not that exciting. Yeah, it's been doing okay, but we could say the same about the oil sector. We could say the same about the real estate market. There's very few REITs that are actually like going to the moon for whatever reason. And their valuations have come back after the pandemic. So they're trading at fair values. They're at par or above. So there's nothing in the market right now that I think people are inept to just want to dive into. I mean, Meet Kevin's been aggressively talking about stacking cash. Yes, Francisco mentions here, or buying into anything. You should always be buying into things. So this is where I'm going to just kind of pivot this conversation to those of you that might be new to the market. When you're talking about these speculative markets, because I own Bitcoin, I own Tesla, I get it. I'm not arguing the fact that they're overvalued or they could be in some form of a bubble. There's no doubt about that. But I'm also somebody coming from a position that has made my money on it. And I've also kind of moved on from a lot of these into some varying degrees, right? I'm not sitting on a huge amount of risk like I used to be. However, we need to go back to the fundamental basis of cash flow here. So real estate is one of my favorite markets to pay attention to right now because it is in a cyclical boom, especially in Ontario where I live. It's absolutely insane. Home values have doubled in almost a year. I watched my parents' property here go from 1.2 to almost $2 million and $800,000 gain in under a year. Astronomical stuff, right? But the disconnect that is going on right now is the difference in cash flow. When we're talking about rental units or buying apartments, at the end of the day, you shouldn't have to worry about asset prices increasing or decreasing because the math should make it so you're at least making a 3 to 6% return in cash flow that's going into your pocket after rent, interest, expenses, and everything else in between. I want to use real estate as kind of the example because that's how we got to kind of look at every stock that we're buying that flows dividends. We're looking for a company that can cash flow within a reasonable amount of their free cash flow to make sure that the bills are paid. There's nothing crazy that could come up in the future that could disrupt them immensely. And that cash flow is going to be sustainable for the long term, right? And I'm going to come through some of your questions here. If you guys have any questions or comments, we can dive into as well. But this is kind of something that's really interesting because there's no good numbers on any stocks. It doesn't matter if we're Microsoft. It doesn't matter if we're Google, which doesn't pay a dividend. It doesn't matter if you're Apple for that matter at this point. You can't run math that will make sense around the cash flow that is generating. I mean, from the balance sheet, it's great. But you could talk about the fact that they have $50 billion, $100 billion in cash, and that's phenomenal. Cash is the worst investment right now, but that doesn't relate to what is going on right now with the cash flow they're generating, right? Because at the end of the day, you could have all the cash in the world, but if you can only generate so much, you can only peak a certain value on it until they reinvest that cash flow, add more value, whatever. So the reason that this is kind of becoming confusing and complicated is because you can't find anything in the real estate market. It's hard in the stock market right now to find something worth investing into where you have a high degree of comfort that the company can grow, the stock can grow, and the dividends will grow without overpaying for it. So the idea is, honestly, you want to be diversified. This is the market where you want to head into diversification. So honestly, you got to recognize what you need to trade, whether it's swing trading, short-term momentum plays, and you need to understand what you're doing when you're buying these companies like Tesla right now, because you could say I'm holding on to it for 20 years, but I don't think you can stomach the down periods. And I know most people can't because I can look at a lot of examples of people bitch when they've been holding these stocks for a year or two, like ARK example. ARK ETFs are down. People are bitching about them now. They're calling Cathie Wood out because she's not keeping up with the market. And they haven't even given time for the next 3, 5, 10 years to actually kind of bake into that investment, which means they didn't really do enough due diligence to be comfortable with the drops. You need to be excited when the market goes down, and you need to know how to prep yourself for it. And cash flow is bar none the best way to do this. So what you're going to want to do, and I'm finding it way easier in the Canadian market than the US market right now, because Canadian banks, they still pay really great yields compared to the US. They cash flow incredibly. They're a lot less volatile volatile, and they just steadily go up and down, maybe 3 to 5% on their worst swings, usually typically over long periods of time as well. And what you're going to want to do obviously is generate as much cash flow right now as you possibly can from the growth if you are involved in momentum plays, if you are involved in the crypto market, because I just don't think amicably you're going to be able to handle a 70% correction like we're seeing in Zoom right now. For example, if you're holding Zoom right now or Alibaba, you're feeling the pain, right? Some of you have the tolerance to buy more, some of you are taking it on from a different risk perspective, sure, lots of fun in that aspect, but you want to be in a position where you know that you can draw against that capital to reinvest it when the markets tank. Because unfortunately, we don't know, and most people will not hold cash. It's a bad time to hold cash, especially in a market that keeps going up. But you don't want to have no plan for when some of these markets turn back around. And if you like Tesla, I don't like it here. I'm not buying it here. I bought it in the 600s, 700s, whatever, it was fine. I thought it could have went lower than that. But I'm not advocating people to come into these markets and just start buying these, right? So you need to be in a position where you can take full advantage of a market correction through a few different facets that I'm going to talk about, but I'm not going to advise people do this. I did it in the March 2020 crash, and it made me a lot more comfortable with it. But I think it's important to recognize how much cash can you get access to if a market corrects, because you're going to get rich when it drops. You don't know how low it goes, but if you know it corrects 20 or 30%, that is a good time to just be caking in cash flow. So what you're going to want to, what I'm doing, not what you're going to want to do, what I'm doing is building up margin accounts. I have zero debt, and I have no problem utilizing debt to buy assets. I've considered it, obviously, if you're ever buying real estate, of course, but when you're taking on risk with debt, there has to be a margin of safety to some degree, and a margin of safety can be built. I know a margin of safety is almost a joke of an idea to me because it's based off technical factors. There is no margin of safety you can calculate into a stock. A stock can go as low as it wants, and there is no how low can it go, because it can always go lower. And that's another thing I find funny. People are like, this is the bottom. Alibaba, this is the bottom. 170 is the bottom. 200 is the bottom. And here we are at 130, right? There's no limits on that. But however, if the stock has dropped such an insane amount that the valuations start coming into play, which is how Warren Buffett would probably call the margin of safety. What do I think the real value is on this company? How low is it? And, at that point, like, you're giving yourself this bleed room of knowing that you're paying less than the company's worth. So you'll have a little bit of margin of safety, kind of like buying a business, right? Like if you buy a business, you don't want to hold on to it for long, like a physical business. Like you want to make sure that it cash flows sustainably and you're not overpaying for it, because you may have to resell it in a short period of time. And if you can't sell it for more than you paid for it, it's because you overpaid for it. So you're going to be a little careful with that. But I'm loading up on margin. I'm loading up, continuing to try and expand my line of credits right now. I am loading up on cash. And I think it's better to appropriate it this way, because what I'll end up doing is what I did in March of 2020. If a correction ever comes into play, I will leverage the debt and I'll keep the cash. Because in March of 2020, we were buying Ryokan for $14 a share. It was cash flowing 9%. My interest is 3 to 4%. It's like a no brainer when you look at the margin of safety on the scope of how far these fundamental stocks dropped. And we made good money. I mean, it was an easy play, but back then it was easy. I wouldn't do it now, right? Like it's too scary now. So this is where you want to kind of build up that war chest and just get yourself prepped that way. And the second way that I'm doing this as well is by constantly reinvesting dividends into cash flow. Right now, the only thing I've been really buying is Bitcoin. It's kind of an experimental play for me. I don't really want to go down that subject. We can talk a little bit about how I look at it, but honestly, I understand both sides of the risk that come with that. But primarily with my dividends, and again, most of the Bitcoin I'm buying is through referrals, free Bitcoin, some other stuff that I do where it's not actually costing me any money out of pocket. So I'm finding I can get some risk on the table that way. However, when it comes to my actual accounts, and I've talked about this with my tax-free savings account, I don't want to own high growth stocks in my tax-free savings account right now. I want to be very careful in Canada here, because it's great making tax-free capital gains, but the problem is if the market tanks, you're going to be in a position where you might have to take a loss and you'll never get that contribution room back. That means you're going to have to reinvest and work your way back up to that amount of available room. It's very scary stuff to take on high risk in a TFSA, because it's tax-free income in perpetuity for the rest of your life. It is probably Kevin O'Leary's favorite saying. Nobody respects it enough. And it's a godsend for the Canadian economy, I swear to God. But the problem is people don't take it literally or seriously enough. And this is a position now where I am primarily only focusing on of the safest investments I can make in my TFSA. Anything that will generate a reasonable cash flow, and I don't care if it's 2 or 3%. I'm not looking for 6, 8% gainers. I don't like high yielding stocks. Unfortunately, I have been burned way too much on high yielders. I would rather buy a fundamental based company like Toronto Dominion Bank, Bank of Nova Scotia, Canadian Imperial Bank, some of the utilities, which are really boring and have been trading down this year. my REITs, my Stag Industrials, my Vanguard S&P 500 indexes. The only growth stocks I primarily hold in a TFSA is Apple and Microsoft. Best decision I ever made because they're primarily at all-time highs, and my TFSA is 100,000 above my contribution room. And when the market tanks, this is going to be the best opportunity to utilize that tax-free cash flow to take advantage and constantly have the opportunity to reinvest every month. I feel like people get way too giddy. They want to dump all that cash in at once. Hyperinflation sucks. I get it. But guys, you're losing your upside. There's no upside. I cannot wrap my head around any near-term upside in the market. And if it keeps going up, it's not going up on anything that's fundamentally based. And it's easy to know this. This isn't rocket science, guys. Markets go up in the beginning off a voting machine, but at the end of the day, the valuation will always come back into play. It's true for Zoom. It's true for the SPAC stocks. And it is going to be true for almost everything in the crypto market. There are no fundamental assets that you can tie anything to that would come down into the realm of reasonable valuations, right? The EV market, all this shit. It's insane. It's the definition of insane. So when it crashes, and it inevitably will, just take advantage of it and have the opportunity to have margin, cash flow, anything that you can utilize. I primarily am really looking at the real estate market, to be honest. I would absolutely love to buy some form of real estate. I don't want to pay rent. I don't mind renting for the next 2 or 3 years. So we're talking about this pretty aggressively, that I think the real estate market eventually is going to go through some form of a correction or a bust cycle. I just can't see how it's not going to happen when we're in a moment of basically everything that ties into an inflated market in real estate. I mean, we're seeing a disconnect again, cash flow, the rental prices here in Canada. A lot of the rental markets are locked for a 1 or 2% increase. So if you can only raise rents 1 or 2% a year, how are capital gains, going up 50 to 100% a year? That is obviously unsustainable in the near term. Again, I'm a long-term bull. If you can, buy a good valuation home and you're holding on to it for the next 20 or 30 years of rental property, there's nothing wrong with that. I would say the same thing about buying speculative things like Tesla, but I just don't think most people come in with that mindset. And I'm somebody that's primarily made most of my money in this market buying dips, buying things underrated, buying things that are highly controversial. Controversial typically leads to much higher returns, obviously also related to volatility. You want to make 1,000% return, you're not going to make it off your Coca-Cola stock. You got to go to where things are doing 50 to 150% movements regularly, right? That's where you got to go. And unfortunately, you got to stomach the insanity that comes with that. So for me personally, like I said, I really would love to get into the real estate market. I'm in a position where if this continues, like I should be making enough to, get to the point of a down payment or something like that. And I'm hoping, because I'm patient, I'm not going to fight somebody over friggin' hammering a stake that says sold into the ground when people are buying real estate within 1 to 2 days of it hitting the market sight unseen. That's literally what's happening right now. You don't have time to do house tours anymore. That doesn't exist in this market. I'm seeing that around me. I don't know if you guys are seeing it around you, but it scares the living hell out of me when real estate isn't on the market for more than 2 days. So I mean, I want to be in a position because, again, I'm fortunate to have built out a portfolio. I'm fortunate to have taken advantage of these markets for the last several years. I've done very successfully with it. It's super awesome, whatever. But I also need to humble myself a little bit and remind myself that you don't know what's going on. It's easy to hindsight backwards and say would have, should have, could have. But the only thing you can really do is prep to the most reasonable place of certainty. And that isn't selling your stocks. That isn't being cash. That isn't throwing all your money in gold. That isn't thinking that you could do the moonshoot with the Bitcoin or an altcoin, right? It's about diversification and risk assessment based off your current circumstance. And I think I'm not going to tell you guys for your own circumstances, but I think it's probably one of the most important lessons that have kept me from losing my wealth. Because again, I have played some insanely volatile industries. I allocated to what I felt I was willing to 100% lose. And I say that every time I go into those companies. We said it about MindMed. I thought about it when I was buying Canopy in the early days. I still think about it, even with Tesla, even though I think Tesla's got a base now, I don't think it'll ever go bankrupt like it could have maybe 3, 4, 5 years ago when they had a lot of issues. But again, when you're looking at things that are too nuanced, like Rivian, a lot of these companies that have no proven track record. And again, yeah, I could say this about so many companies and industries right now. You just have to understand what you're doing. And you have to understand that you can lose money, a lot of it. And again, I mean, people with highly on right now getting beat up, a lot of the SPACs getting just devastated, and it's going to come back around. And like I said, my diversification, if I can touch base on one more thing here, and we'll get into a Q&A. I can't get over it. It kind of stumbles me a little bit, and I don't talk about it a lot, but I'm globally diversified in a way I don't think people in the US are. I come from Canada. I know the Great White North. A lot of you may be Canadians, but Canadians don't have a choice because everybody wants to invest in the US market. But because we're not from the US, I feel like we don't lived in that locked in bubble where people really don't look much beyond what is in front of their face. I mean, I just don't feel like enough people get on a plane and are willing to go to some third world country to just kind of get an experience of how some of these other markets operate. And I think that's kind of true for Canada. Canada to me it is one of the fastest first world growing nations by population because our population is so small. It is exploding thanks to immigration and a lot of other rules, right? But I have allocated 50% of my capital to Canadian companies and US companies. Yet you'll only really hear me talk about the US companies that I buy. But when I look at the performance of my portfolio, it's not nearly as rough as almost every portfolio I look at amongst all the US YouTubers. And I noticed that none of them own any real foreign stocks. And I kind of find it interesting because I'm like, it's so weird to me that like the idea of a foreign stock to most people in the US is a Vanguard, total market index fund. And it kind of blows my mind because I'm like, when I'm looking at how well like the Canadian stocks are doing, when you could have bought one of our banks when the crash. And by the way, the Canadian banks are world renowned for stability. We rode through 2008. The Canadian banks have been so robust. They are literally like almost the Switzerland banks with like world renowned ratings. It's insane. And they've done a great job, right? You could have been buying Canadian Imperial Bank, Toronto Dominion Bank when they were ripping out 6 to 9% yields and could still afford them in the crash. It was like unbelievable. And I was like, hey, and a lot of people in this chat group were all on board with me, right? We were buying the banks. I sold Apple to buy these banks. I was buying Ryokan with margin. I don't know anybody in the US that would margin capital on Canadian stocks. So, I mean, I just feel like people need to understand that there are other markets out there that can offer so much stability to your portfolio because with Apple, with Tesla just going like this, 50% of my stocks have done nothing but steadily go up, and they have nothing to do with the US market. So I mean, I just want to throw that out there as a little anecdote, a little tidbit of advice, because I just don't think people appreciate global diversification in a way that's actually beneficial to their portfolio because they're scared. When I got into it, I was scared paying a 15% withholding tax. If you're buying foreign stocks, expect to pay higher tax. However, from the diversification standpoint, in a world of hyperinflation, diversity, diversify your risk, diversify your cash flow, and just make sure you're setting yourself up to take advantage. On that note, questions, Q&A, folks. I'm just kind of rambling. These live streams are very entertaining in this market for me right now. So I'm tired. I'm exhausted. If I could show you guys what my work schedule looks like right now, you'd probably laugh because I can't even believe it. I think I've got 10 calls tomorrow in between a bunch of other crap. Banks doubled now. Sahib, yeah, I know, man. The Canadian banks are crushing it. Like I said, I mean, pull up any Canadian bank. I think TD hit all-time highs the other day. Let's take a look. TD stock. How's my TD bank? This is one of the only Canadian banks that I've been averaging into lately. Yeah, I mean, we look at the 5-year chart on that. It's like insanely stable, and the only time it's experienced pain was in the market correction, right? Why real estate when you can make more with a business? Because I'm making money. Simple thing. I believe in like what Grant Cardone says. You shouldn't have all of your assets in real estate. If the vast majority of your wealth has been created in real estate and that's where all your money is and you're broke making monthly payments, that's dumb. I mean, like Grant Cardone says, overpay for rent so you can invest in a business and grow cash flow. I'm already there. I'm running a corporation. I'm running multiple, all my tax-free savings accounts are maxed. I mean, I could get to the point right now where I could make $1,000 a month in dividends if I ever had to make those decisions. I have a great job. Things are just really working in my favor right now. And I still think I could be in a position where I could save up a down payment, but not have to give up my entire portfolio. I will never sell all of my stocks to invest in real estate because that defeats the purpose of diversity. Now, most people I don't think should be buying real estate because I think they'll be working their ass into the ground for the next 10 or 15 years just to keep up with it. But if you're in a position of diversity, I mean, I don't think there's anything wrong with trying to put yourself in a position to not pay rent. Real estate is the cheapest and largest method of margin leverage you'll ever get. Yeah, and I don't want to be in a position either where I'm over leveraged in debt. Because let's say average Canadian house right now is worth around $900,000, 8 or 900,000 across Ontario. absolutely mind-boggling. I'm telling you, 2 hours anywhere near Toronto, you're at least paying a million for a decent property. So let's presume you're putting a 20% down payment. I mean, you're going to be coming up with 200 grand and you're going to be left with an $800,000 debt. And that's going to be probably financed at 2 or 3%. You're probably going to get a fixed rate for like 5, 10 years, whatever. Maybe get a little bit lower than that, down to 2%. But now you're paying, close to $3,000 a month when you before you're even popping on property taxes, any kind of repair. I mean, it's astronomical. You need to be making 4 or 5 thousand a month to afford a house anywhere within 2 hours of Toronto. So I don't want to be in a position where I am forced to basically be 800 grand in debt. That's insane to me. I wouldn't do it unless it was a 50-50 stake. Like, the idea for me is if I could find a property or condo or whatever for like 5 to 700,000, you put your 20% down so you don't need to get insurance, like a renter's or mortgage insurance, so you can avoid that payment. And then so long as you have enough to say cover at least 50% of the difference, for me anyway. So if I can have $300,000 or $400,000 in stocks and I can own a $400,000 or $500,000 mortgage, to me that's a good kind of 50-50 ratio. I mean, that's how most real estate REITs even operate. That's how most good highly leveraged companies operate. You usually don't want to start getting into that 80% margin rate, right? And that's where I'm potentially going to be in the next 2 to 3 years. I'm not saying I'm going out to buy real estate tomorrow. It would be a little insensible. But if the markets come into a correction, we see interest rates go up, it would make sense if I can come up with another 100 or a couple 100,000 between me, not just myself, me and my girlfriend. I mean, things will probably evolve over time here, and I'll be in a much better position by then. Instead, be in a position where you rent forever, and have that go up by higher than inflation every single year, including into rent. Um, I'm sorry, I'm not exactly sure what you mean. Instead be in a position where you rent forever and have to go up by high. I think you see, this is the disconnect. If you're talking about like paying rent and having rent go up forever, I 100% agree. But if you're in a business where you're making $1 million a year and you don't want to own real estate and you're flying around I mean, overpay for rent. I mean, I know lots of Facebook guys and YouTubers that are paying like $7,000 a month for crazy, condos and stuff, and they don't care because they just have so much money. But the difference too, I think it's a good point, is in Canada, you can anticipate the rental increases. I mean, most places, and I can imagine this is how it is in the US, is that things are rental locked. And this is how they bullshit inflation, right? Because if you know how high rents can go and they get capped, and they're literally 1 to 2% a year in Ontario for most places. So it doesn't matter how much that capital goes up in the market. You can't raise my rent beyond the marginal rate that exists as the market. I don't know how they determine it. But then once you've got that rent, typically if the owner wants to raise it 1 or 2%, that's where they're locked. Without a 20% down, you don't even stand a chance to secure something. CMBC is not even a concern, or CMHC, sorry, is not even a concern. Yeah, no, I agree. I agree. But again, like Sahib, I mean, you're probably in a position to, I think you've done pretty well with some real estate. And again, like I'm not coming from the perspective of somebody else. Like, I'm in a position where I can start making sense of it if things continue to go the way they're going, of course. And again, I've got really good family support. Not that I would be leaning into them to buy a house, but I highly doubt that I would be able to buy a property without a co-signer. There's no way I could see that happening. They can renovate, kick you out, or move. Yeah, 100%. I mean, if the tenant wants to kick you out, but that's why you have a lease. I mean, the stuff you guys are talking about, you're acting like people don't know this shit. It's just like, no shit, rents are going to go up. I mean, you could get kicked out at the end of your lease, but that's why you have a lease, so you know how long you can stay there for. And if they decide to move you, then you got to go find another place. It's the joys of not owning the house. But again, in that position, you have the freedom of cash. When you own a house and you're paying 4,000 or 5,000 a month mortgage, you and your wife working 2 jobs, making 100, 150,000 a year, giving up like 80 grand of that to real estate, like, you're not in a good position to leverage it into businesses or the stock market or something that could cash flow a greater return than you're paying for rent. Like, if my business, I can continue to put money in it and it'll grow by 100% a year in revenue, why the hell would I put that into a property? I mean, not even a rental property would, well, maybe in this market for capital gains, they'll give you that kind of return. But I mean, it's circumstantial to your own position, right? Like, I think if you have no money, no savings, and you're trying to buy a house, if it's not a rental property and you think you understand, and maybe you're a realtor or something, it would be stupid not to invest into yourself first. You got to make sure, right? But there's nothing wrong with renting. I don't think there's anything wrong with renting if you're utilizing it for the right reasons. Um, And again, like I said, it's not like it's a bad thing. I mean, you're not, you can anticipate within a year or two what's going to happen. I mean, you can extend out 2 or 3 year leases if you want to live there for that long. Would you use leverage against your TFSA? Quest Trade allows you to use margin in case there's a downturn, for example. I wouldn't use margin in my TFSA. I honestly, man, I look at that as my golden goose. I know a lot of people might be building those accounts up, and if margin's something that fits your risk tolerance, by all means, I will not use margin in my TFSA. Like I said, I got very fortunate early on, and I think my contribution limit on my TFSA is around 69,000, and I'm at like 160 something thousand right now. So I just do not want to put that risk in something that is just so insurmountable to a value to me. I mean, if for example, I think that account makes me about $4,500. So that's what, maybe 3%, 3.5%, not including my yield on cost, because it'd be astronomical at this point. But as over the whole portfolio, I'm yielding, let's say 3%. If I can continue to have that capital grow, because obviously I've been done really well with the growth stock stag. If those things can even grow at a 10% stake a year, or let's say even a 5%, and I'm able to cash flow 3%, that's 8% a year. And on 100 grand or 150,000, I mean, that's what, if I can run the math on the top of my head, well, 10%, obviously on 100 grand is $10,000. So, if you're getting that, that's what, I mean, $1,000 a month tax-free income. I just don't want to screw that up. I'm too young. I'm 29 years old. I don't need that kind of risk when I understand the long-term security that offers, and I don't want to lose it. So I'm just really prudent with my money in there. And in fact, I'll tell you the positions for those of you that don't know in my TFSA, just to give you an idea of how I kind of structure it, because I feel like buying individual stocks is already risky enough within that account. But let me just pull it up real quick, and maybe I can show you guys kind of how I set this up, because this is perfect, by the way. This is everything that I that I run philosophy about in my investment strategies. But in my TFSA, I have two accounts. I have a Canadian and US holding account. I separate my currencies and my US holdings. I currently have $61,000 in Canadian valued investments in Canadian dollars. And in US, I currently have 79,000 US dollars in US investments. On the Canadian side, I want to buy more. I feel like I'm a little under diversified, but I got Bank of Nova Scotia, Canadian Imperial Bank, Northland Power, Toronto Dominion Bank, and Algonquin Power. Over time, my goal is to continue to add back in RioCan, and I also want to get TELUS Communications within this account. Right now, those two companies are outside of these tax advantaged accounts. In the US side, I've got Apple, I've got Microsoft, I've got Southern Company, I've got Medical Properties Trust, Stag Industrial, and the Vanguard S&P 500 ETF, right? So I feel like these very few holdings that I do have are already risky enough. To most people at this point, I'm sure index funds would probably be more appropriate, but I live for the cash flow. And I know I don't talk about dividends as much, but the vast majority of my portfolio is focused around stocks that pay dividends. And in my corporation is where I focus on growth. My corporate account will always be primarily growth, because inevitably that money comes with a lot more restrictions, and I don't think cash flow matters as much as trying to build the business. We get you vape. No, Baba, I see. That was interesting. You guys have any more fun Q&A? Stag is a good in an RSP, because yeah. So if you're Canadian, the registered retirement savings plan, you do not pay withholding tax, whereas I do pay withholding tax on my US stocks in the TFSA. With the RRSP, yeah, you don't pay any withholding tax. So that's why I do hold in the RRSP. I actually only hold US companies in here because of that reason, because I know I can hold lower yielding stocks and not have to pay up any more of the percentage. So I own Pepsi, Johnson & Johnson, and the Vanguard S&P 500 ETF. Renting makes a lot of sense for people who own businesses and own stocks. Renting is the only option, my man. Is there another option? Can you afford a house in this market? I don't live in the US. I wish I did, because you guys can buy real estate where you're paying 300 to 500,000 US, and you get reasonable homes. I have to move into the middle of nowhere. Literally no airports, no hospitals. Like, you're living in the bloody woods of Manitoba, Winnipeg, Newfoundland, Nunavut. You don't even know those places exist if you're watching this as a US investor. And you can buy mansions there for $500,000. Fuck, you're spending 200 grand. You're getting a 3-bedroom, 2-bath, furnished basement, 2,000 square foot home. I mean, it sucks. It totally sucks. I could do it, but I don't want to. Alberta for 400 or 500K. Yeah, Alberta is another fairly reasonable place still. It's not bad. I need to be near an airport. If I can't Uber to an airport, I don't want to live there. That's unfortunate about Canada because the best thing about the US, everything about the US is designed around airports. I feel like Vegas, San Diego, don't matter where you're flying to, most of the states, you're within an hour drive of where you need to go from an airport. I like that lifestyle. I like in Canada. You're an hour away from everything. It doesn't matter. Probably longer than that. I mean, Toronto's an hour away from the airport. Let's be real. Traffic's brutal. You can buy 400K in Alberta, yeah, Nunavut, FML. Edmonton is affordable. I'm giving serious thought. Yeah, I know a lot of people that are moving farther up north. A lot of people like that lifestyle. It's becoming a retirement idea. A lot of people move from the city, move out here. The people out here move further up north. They're getting to retirement. Can't move to the U.S. I could move to the U.S. I mean, it's something that I've contemplated, but primarily I like my home. I like Canada. I love my area. Um, I also really like Vegas a lot. I really like some of the others. Like, I mean, the U.S. has a lot of beautiful places too, but home is home, right? Like Toronto's my home city. I started my business here. I've worked for some of the. I literally worked for the largest companies in Canada. I've got to introduce the CEOs of like the Royal Bank and stuff at my old job. Really cool stuff. I mean, it's just kind of part of my DNA at this point, and I don't really want to give that up too much. But problem comes with obviously pricing. Texas and Nevada have tons of cheap houses. I could afford a condo like on the strip of Vegas for like 300 or 400 grand. It's crazy. Yet a condo here, like the average condo, you're spending at least 6 to 800,000. It's astronomically like way more. But I think there's a bit of a difference there too, right? Because in the US, you guys got to pay health insurance. I mean, you guys have a few other bills which are astronomical to me. I mean, when I went to Vegas, I was blown away by the deductible our driver was paying. This kid was 19 years old and paying a $400 month deductible for health insurance. And I was like, holy crap, $400 a month for health insurance. God, it took me like 8 years to get my car insurance under $100 a month. I couldn't imagine paying $400 a month for insurance or health insurance. Canada, I can just walk in anywhere and they'll patch me up if I got a broken leg or if I'm having a heart attack or something. You just go straight to Emerge and somebody's there and you come out with no bills. Keep in mind, there are medical bills when it comes to drugs and stuff like that. It's not like that perfect because obviously, unfortunately, if you get diagnosed with certain things, you do want health insurance, but I mean, it's a little bit different. I think here in the US or in Canada, a lot of the health insurance companies actually they actually you can use them as a savings account. I don't like them personally. I mean, I discussed this with a few people. I mean, there's some variable options to it, but basically, if you never draw against the health insurance, they actually they give you a percentage back at a certain point. It's kind of interesting how it works. Actually, I used to live in Toronto and moved to Eastern Europe. How's Eastern Europe, man? Europe's a little bit interesting right now. I think you missed deductible, unless I'm saying that incorrectly. It might not be the deductible. Um, yeah, sorry, I'm not an insurance guy. The dude just said he was paying $400 a month. Do you mean 400 monthly premium? Yeah, it might be the monthly premium. I'm not an insurance guy. I'm just talking out of my ass here, so don't bear with me if I'm misquoting the statements. You get the general idea, especially if you live in the U.S. I'm sure you understand the insanity of health insurance. Everything is way cheaper in Eastern Europe. Eastern Europe's pretty beautiful too, but they're also how's it going there? I mean, the news in Europe is interesting. You guys have been going through a lot of weird stuff, Brexit, a lot of volatility with the pandemic. I love Banff. How dare you? Thoughts on Nvidia? Nvidia is another one of these companies I think is a huge momentum play right now. Don't want to touch it. I'm waiting. I'm hoping. I'm praying it drops. Again, a lot of stocks, guys. Like I said, I'm not buying Google here. I'm not buying Nvidia. I want to. I'm not buying Tesla. I've dried up. I've dried up, my folks. It's a sad day when I don't want to be buying tech stocks anymore. But again, I got my allocations at great prices. You guys want to see what I was buying Apple for? This is laughable. This is how long I've been in the market, folks. I don't know how long you guys been investing for, but Apple is one of the only stocks I've only ever sold in my investing history. And I'm glad I bought enough of it to constantly sell it over the years because I still own a lot. I think I own how many shares of Apple? I got 100 shares of Apple. The last time I bought Apple, this is crazy. The price, obviously, it's kind of pre-calculated into the split. I was paying $17.25 a share for Apple. My yield, my dividend yield off Apple is 5%. The idiot that I was selling Apple over the years, I made some good decisions with it. I did well with some of the rebuys and the redistributions. Right now I have a $1,700 investment in Apple. It's worth 16,000 bucks. Yeah, I'm not buying Apple here though. Should have held. I should have, but again, I made good choices. Hey, I sold Apple to buy banks in March of 2020. I think I sold, how many shares of Apple did I sell? Like three or $4,000 worth, and I shuffled most of it into the Canadian banks. That worked out well. That worked out real well. Maybe it's for me, but tech stocks are showing some cracks in the market. So look, I truly believe we are in one of the greatest growth cycles. I'm going to finish up by saying this, folks. We're 45 minutes deep here. I need to go eat, chill out a little bit before things get even more insane tomorrow. But I just want to finish by kind of tidbitting this because I am a true believer that we are in one of the greatest growth cycles you are ever going to experience in the history of the stock market. We are seeing a technological shift that is just as great or greater than the Industrial Revolution. That was the last time we saw a massive explosion going from steam engines, printing presses. Factories, when we're talking about large scale consumer factories coming into fruition. And then we kind of stagnated for a little while until we saw the interruption between telecom, the internet started coming about. And now we're into this new cycle where basically every aspect of every sector is about to go through a technological shift. We're going to have it in the infrastructure when we're talking about utilities is probably going to be one of the greatest. And we're seeing it happen, obviously, with the energy storage. We're seeing people, obviously, every country right now fighting to get through carbon emissions, et cetera, et cetera. EVs, auto industry's changing, fintech, all the banking systems are going to change. Crypto is going to be a huge competitor to any kind of value, in my opinion, when it comes to currency exchange. It is becoming its own asset tradable value. I think those are going to become bigger and bigger things that are going to be discussions at the forefront for a very long time. I just recognize that in this current macro moment, that this excitement that I am discussing to you gets baked in early to the stock price. And that's the problem. Typically, what I like to see is slow movements based off earning valuations, right? Like typically, an earnings come out, people get excited, traders trade, there's some volatility, and they smash earnings, and the stock goes up 10, 15%. And then we see some slight movements, and then maybe the next earnings come, it's not as good. The stock drops 5%. People continue to cost average in. Like that's the kind of stuff I like to see over a long period of time while this stuff bakes in. But unfortunately, that's not what's going on, right? Like we're seeing that the macro aspect of valuations doing this hockey stick and momentum always eventually comes down. Problem, we don't know how high and we don't know how low it drops. That's the problem with predicting a crash, right? Could you imagine somebody in 2012 saying this market is overvalued? I'm never buying this market. I'm waiting for a crash. They wait till 2020. The market drops 20, 30%. And they're like, damn it, it didn't drop to where it was in 2012, right? This comes back to the idea of diversification and just owning a broad mix of your risk tolerance. And I think everyone should own crypto. I think a lot of people should have been, not now, but should have been exposed to the EV markets. I think a lot of people should dabble in this stuff, but you have to come at it at a perspective of, I know I'm overpaying for it today. So make sure tomorrow, if it isn't overvalued, that I still have an opportunity to take advantage of it. And like I said, I'm just a little worried. I think these kind of valuations we're seeing today, I would expect more likely probably 2 or 3 years from now. When you look at analyst price targets on these things, guys, we're all technically analysts. There's some analysts. I should do a video on analysts that I actually like listening to, because some of these guys have been pulling 50% gains for like the last 7 years. Like some of these guys have done astronomically well. And when you look at the highest end price targets on a lot of these tech stocks, we are above them. We are above them for the macro valuations that these guys are giving on them. So if you're buying Google stock, what valuation are you giving it? Are you expecting to make a 10 or 15% return next year? Good luck, because the valuation analysts give on the return for Google next year is in the low, either the very low teens or the single digits. Because how do you make sense of the cash flow? I get it. They're partnered with SpaceX. They are actually going to be working on the internet structure globally for SpaceX. They're getting into self-driving. They got quantum computing going on. Damn it, it is exciting as hell, but that excitement doesn't rendition into reality, right? So it depends on, so I mean, yeah, you can just buy Apple stock. I mean, cost average into these by all means. I'm just glad that I was able to catch Google on the $2,600 dip. Honestly, I think fair value price for Google is around 2,200. A lot of people would give it lower price targets than that. Around 2,200 I think is fair, because I always try and bake in at least 15% of value being hype. Hype stocks, you kind of got to figure out what you think the base value is, and then pop on like 15 or 20% for hype. I mean, that's what I did for Tesla. That's why I was buying Tesla back in the 5 and 600s, because yeah, it should be fair valued probably at $100, but you know, it's never going to go there. It is the hypest of the hype stocks of the entire market. So you have to understand that it will continue to trade that way until things change. Tesla is the only thing that I would be comfortable holding for the next 20 or 30 years because that's how long I plan on holding it. And again, I might take profit on it, but I still will hold a core fundamental position for a long period of time. But I understand that it could drop and flatline like Amazon did for 10 or 15, or I mean, Amazon flatlined for like what, 3 to 5 years. I think that's more likely to happen in the market sometime once we get to interest rates going up. I think when interest rates go up and the logistics nightmare works itself out, that's when we're going to see the real rendition of what this market is like. Because unfortunately, people will be borrowing less money. There'll be less margin. There'll be more money coming off the supply. Interest rates. I mean, that's what interest rates are, right? I mean, you're talking about supply and demand of cash flow. The government's unloading cash into the market, and they say, "Hey, things are getting out of control. Raise interest rates." They start taking some of that back. That's what they're going to do, right? That's the inevitability we're about to hit is a brick wall in the next year. And how that bakes into the market's going to be interesting, along with the logistics problem. I've said this before. Every company that I primarily work with, that I talk to personally, the CEOs, they're all doing one thing. They're stacking up supplies. Doesn't matter what industry. Doesn't matter if it's pharmaceutical. Doesn't matter if it's a shipping industry. It doesn't matter if it's McDonald's. They are finding a way to beat the logistics problem by oversupplying warehousing and packing up supplies for 8 months. Most of these guys I talk to have 8 months of supply because they know it takes about 2 to 3 months to get full supply. What happens when all of the supply is piled up and now there's no problem getting supply and people just have no need for all this crap that's sitting on boats, right? That people aren't building up 8 month supplies anymore. It's going to rattle the market. It's definitely going to rattle the market. And how it comes into fruition, I do not know, but it is an inevitability. Those are realities we are about to face. How it goes down. I want to know what you guys think. Let me know what you think about some of this stuff. It's so crazy. This stuff is so crazy. I can't believe I'm talking about this stuff. It blows my mind. I mean, it's just from what we went through in March of 2020 to where we are now is just so astronomical and such a unique scenario for everything, literally everything. Just to be in a time period like this, to where the markets and the sectors are changing so rapidly and currencies being printed like wildfire. What was it? 40% of the US currency supply just dumped on the market in the last year and a half. Like astronomical shit. That I don't know. Like I said, I don't invest off any of that nonsense. I always cost average. Just be diligent. Do what I said here, guys. Understand your risk and just make sure you're allocated properly. Don't be fearful. Don't ever invest based off stuff we don't know what's going to happen. It's the stupidest thing you'll ever do. And you'll always, in the long term, lose more money trying to predict what the market's going to do rather than just investing correctly and looking for fundamental companies. And yeah, in light of that, folks, I look forward to catching you in the next one. Have a wonderful night. Peace out, everybody.